Alright, let's dive into the sweet trading tool. It's a nifty indicator that helps you get a read on market momentum and sniff out potential reversals with a clever oscillator setup. We're gonna break down what it is, how it pops up on your chart, and how you can use it in your trades, including a slick divergence strategy. If you're vibing with this video, do me a solid and tap that like button below. Let's roll. To kick things off, head over to TradingView, the platform I'm rocking today. You don't have an account yet? No sweat. There's a sign up link in the video description. Once you're in, load up the GBP/JPY chart on the 15-minute time frame. That's what we're zooming in on. But this indicator is pretty chill and works across a bunch of time frames and assets, so feel free to play around and test it out. Next up, click the indicators button at top and search for multi-oscillator adaptive kernel. You'll see the one by Alpha Algos. Grab it and add it to your chart. Pam, here's the multi-oscillator adaptive kernel in all its glory. This thing's designed to help you decode market momentum, spot the main trend, and catch overbought or oversold zones where the price might flip. It's like a smoothie blender, mixing signals from classic oscillators like RSI and stochastic, then smoothing them out with an adaptive kernel track to give you a clearer, less messy view of what the market's up to. So what's on your screen? First thing you'll notice is the indicator gives your price candles a makeover, switching them between a bright teal and a bold magenta based on the oscillator's momentum signals. Down in the indicator panel, you've got the main players, a fast signal line, that thin line bouncing around the zero mark. It's super quick, picking up price changes fast, which makes it great for checking short-term momentum. Above zero, that's bullish energy. Below zero, bearish vibes. Then there's the slow signal line, looking like a histogram or shaded area, also moving above and below zero. It's more laid back, backing up the fast lines signals and giving you a better sense of the bigger trend. It's tracking momentum too, just with a smoother touch. You'll also see a scale centered at zero. The creator suggests using the 50 level for overextension, but I found 40 works like a charm. Let's make it pop. Grab the horizontal line tool, drop it anywhere, double click, and set it to 40. That's your guide for when the market's stretched too far upward. Do it again for the downside. Add another line, double click, and set it to -40. Now you've got clear zones to watch for potential exhaustion points. Let's take a quick look at the settings. Open them up and you'll find a few sections. In the oscillator section tab, you can choose stuff like the price data source, close, open, whatever, and set lengths for built-in oscillators like RSI, default is 14, stochastic, default is at 10, MFI, default is 14, and CCI, and is by default is at 20, sometimes off. For the strategy we're talking about, we're keeping the defaults, so no need to tweak unless you're itching to experiment later. Then there's the kernel setting tab, where you can pick a kernel type, exponential, linear, or Gaussian, to tweak how the indicator smooths data. Mess around with these on different charts and time frames to find what clicks for you. You've also got kernel length and sensitivity to fine-tune how responsive it is. More ways to customize. There's a toggle to show or hide the color candles. I'm keeping them on because I like the look. In the Style tab, you can change colors and visibility. My only suggestion? Maybe make the fast signal line thicker so it stands out. Hit OK when you're done. Now let's get to the fun part. How to trade with this indicator. The simplest way is to check the market's trend and momentum. Look at the fast signal line and slow signal histogram. Both above zero and shining teal, that's a strong bullish trend with positive momentum. Both below zero and glowing magenta, you're in a bearish zone with downward energy. You can even measure how strong the momentum is. In a bullish trend, if the fast line is riding above the slow histogram, the bullish vibes are strong and may be getting stronger. But if the fast line dips into the slow histogram's area while still above zero, the bullish energy might be cooling off, even if the trend is still up. Flip it for bearish trends. Fast line below the slow histogram and both below zero means solid bearish momentum. If the fast line creeps up into the slow histogram but it stays below zero, the bearish juice might be fading. This can help you pick your spots. Maybe only trade when momentum's heating up and skip trades when it's losing steam. For a more specific setup, let's talk about using those plus 40 and minus 40 overextension levels with divergence. Here's a bearish setup for a short trade. First, wait for the market to stretch too far upward, looking overbought. Step 1, the slow signal histogram crosses above that plus 40 line we set. Then fast lines are usually up there too, but don't jump in yet. Now watch for bearish divergence. Price making higher highs while the oscillator is making lower highs. You want a clear difference, like two price peaks climbing but the slow histogram's two peaks dropping. The second lower than the first. Once you spot this and the slow histogram falls back below plus 40, that's your signal to go short. Enter the trade, set your stop loss just above the latest swing high from that peak, and aim for a take profit twice your risk for a 1-to-2 risk-reward ratio. Let it play out. And as you can see, it was profitable. For a bullish setup, just flip it. Wait for a slow histogram to drop below minus 40, signaling oversold. Look for a bullish divergence. Price hitting lower lows while the oscillator makes higher lows. The second, higher than the first. When the slow histogram climbs back above minus 40, enter a long trade. Set your stop loss below the recent swing low and target twice your risk for take profit. It's a clever way to catch reversals when the market's gone too far and it starts showing signs of slowing down through divergence. To wrap it up, the multi-oscillator adaptive kernel is a versatile tool that gives you a clear view of momentum and trend direction with its fast and slow signal lines and candle colors. It also helps you spot reversal zones using oscillator readings and those overextension levels, especially when paired with divergence. It cuts through the noise from multiple oscillators to give you a solid way to gauge momentum, strength, and find market exhaustion points. Just a quick note, this is not a financial advice. The strategy here is just indicators and meant for learning to show you how this tool works. For real trading, mix in your own analysis, price action, support and resistance, fundamentals, smart money concepts, whatever suits your style. And if you're looking for the best of best, just check the recommended playlist on your screen. You'll find dozens, let's say hundreds of them on my channel which are proven to work. And also, if you're looking for a way to automate your trading strategy, not only this one, but any trading strategy, maybe your existing one, into a bot with others, all for free, so it does job for you while you're not around, make sure to check the other recommended videos on your screen. Oh, and by the way, think of this indicator as one piece of the puzzle, not the whole picture. If you got something out of this and learned about the multi-oscillator adaptive kernel, drop a like. It really helps the channel. Better yet, subscribe for more indicator breakdowns and trading ideas. Thanks for watching, and I'll see you in the next one.